Greetings to all students that are listening to this video, and I'm greeting to you as you are listening to this video. And this is a video on chapter 14 of the Cost and Management Accounting textbook. And chapter 14 is about direct and absorption income statement. So now I will be doing this exercise on the direct and absorption income statement, and it reads as follows. It says MF Limited manufactures and sells a certain product. So they don't tell us what the product is, but they say it's a certain product. The following costs were incurred during the month of October. So now the costs that are below, they are for the month of October in the year 2008. We are given total direct material, and take note that this material is in total and it is 51,000 rands. We are also given direct labor cost, and the labor cost is given only per unit. Also take note of that, and that labor cost is 4 rand per unit. And remember, direct labor cost is a variable cost, therefore variable cost per unit, they remain constant. Be mindful of that. We are also given variable manufacturing overheads cost per unit. So now this is also variable cost of 2 rand 20 cents per unit, and variable cost per unit remain constant. Then we are also given the total fixed manufacturing overheads of 128,000 rands, and this is the total, the amount that is already in total. We are also given the total fixed manufacturing cost of 40,000 rands. Then the 40,000 rands once again is in total, it is not per unit. We are given again variable marketing cost per unit, and remember, variable cost per unit, they remain constant. So now the variable marketing cost is 1 rand 50 cents, and marketing costs are normally based on sales. Marketing costs are normally based on sales. So now this will normally be based on the number of units that were sold. Then after, we are told that the total fixed administration cost is 25,000 rands, and the total variable administration cost, it is 34,000 rands. Then after, we are given the sales price, and that is the sales price per unit, that is 25 rand of the selling price per unit. So now this is the structure of the cost that has been given unto us beforehand. Then after, we have to read further and we see how much more information do we have to observe. It says that MF Limited use machine hours to allocate fixed manufacturing overheads. So now it means our fixed manufacturing overheads are based on the machine hours. Then it further says that the absorption rate is 5 rand per machine hour. Take note, it is per machine hour. So now this is the predetermined overhead rate, which is 5 rand per machine hour, or the absorption rate. And they say it takes 1.25 machine hours or 1.5 machine hours to produce or to complete 1 unit of this product that this company or MF Limited is manufacturing. So now these are the machine hours that it takes to complete 1 unit of the product. And we know that the POR is 5 rand per machine hour. Take note, it is not per unit but per machine hour. Then it further says in the next sentence that on the 1st of October in the year 2008, remember the information that was given was for during the month of October in the year 2008. Then they tell us that in the beginning of October, which is the 1st of October in the year 2008, there were 5,000 production or products in the opening inventory. Then this means this will be our opening inventory. Then after, they further say during the month of October 2008, MF Limited produced 17,000 products, and the closing inventory was on the 31st of October 2008, 6,000 units. So now we are given the opening, we are given the production, and we are given the closing. That means we need to calculate the number of units that were sold. So the number of units that were sold becomes the missing units. Then the number of units that were sold becomes the missing units. Then we have to determine how many units were sold during the month of October. Then they further require us to compile the income statement using both the direct and the absorption method, and they say we must also show the unit cost of the product for each of the methods. Remember, direct method we calculate only variable cost. Then in the case of absorption we calculate the full cost. That means variable cost plus fixed cost. That will give us the total cost per unit, which is full cost to absorption cost per unit. So now with that requirement, then we can immediately start with the missing units. Then after we calculate the cost per unit. So now let us say this is exercise 14.3, where we start by calculating the missing units. And in the missing units, we first have to say that this is for the month of October. This was just to confirm for the month of October. So now we are doing the absorption and the direct income statement for the month of October. Then now we start determining the opening inventory. This is October. We start allocating the opening inventory. Then we record the production. Then our opening inventory was given to be 5,000 units, and our production, I think it was 17,000 units, if my memory still serves me well. Yes, our production was 17,000 units. They said during October 2008, MF Limited produced 17,000 products, and the closing inventory is given to be 6,000 units by the end of the period. So now if we say opening plus production, this will give us units available for sales. This will be units available for sales. These are the units that were available for sales. Then there was closing inventory, and that closing inventory was only 6,000 units. Closing inventory was only 6,000 units. So now that means if we say opening of 5,000 plus 17,000 of production, it will give us 22,000 units that were available for sales during the month of October. Then after we minus the 6,000 of the closing inventory, that will tell us or determine the number of units that were sold during the month of October. Therefore now we say sales or units sold. And units sold will be 22,000 minus 6,000 units that were left. Then 16,000 will be the total units that were sold during the month of October in the case of exercise 14.3. So now these are the units that were sold during the month of October. Then after we need to calculate the unit cost, or we need to calculate what is called the product cost. The product cost per unit. Product cost per unit, or the unit cost. In the product cost per unit, we know that we must have direct material. And we also know that we need to know the direct labor, because remember that total cost of production is made of material and is made of labor, is made of variable manufacturing overheads, and is also made of the fixed cost. So now that will be variable manufacturing overheads. It will be variable overheads. In fact, variable manufacturing overheads to be specific, because this is manufacturing overheads. Variable manufacturing overheads. Then this will give us direct cost per unit. This will give us direct cost per unit. This will give us direct cost per unit, and this direct cost is for the direct income statement method. When we do the direct income statement, this is the amount that we'll take. So now our direct material was given to us as a total of 51,000 rands. there was the direct material, and that was 51,000 rands incurred in order to manufacture the total of the 17,000 units that were manufactured. Remember, there were 17,000 units here at the bottom with the blue pen. 17,000 units were manufactured. Therefore, now if you say 51,000, we divide that by 17,000, then that will give us the direct material cost per unit. That is why we divide by the production, because the 51,000 rands is the 51,000 that was incurred in order to manufacture 17,000 units. Therefore, now we need to know how much is the cost for each unit in terms of the direct material. Then we say 51,000 rands divided by 17,000 units that were manufactured, and this will give us 3 rand per direct material. 3 rand per direct material. So now that will be 3 rand per direct material cost. Then that 3 rand will be our direct material cost that will be recorded as the cost per unit. And we know that our direct labor was already given per unit, and that direct labor was given to us as direct labor per unit. Take note, it's already per unit. We don't have to convert. Therefore, now that will be exactly 4 rand, because we are calculating product cost per unit. We need everything to be per unit. Then now we have to go and check our variable manufacturing cost. Variable manufacturing cost, take note, it must be manufacturing overheads per unit. So it's variable manufacturing overhead cost per unit, and it was already given to us as per unit. Then if it's per unit, we can just take that 2 rand 20 cents as it is, and we record that as 2 rand 20 cents. Then now that will give us direct cost per unit, which is 3 plus 4 plus 2 rand 20 cents. That will give us 9 rand 20 cents. So now 9 rand 20 cents becomes our variable cost per unit, or our direct cost per unit. Then after, now we have to add our fixed cost. Remember, after we added our fixed cost, then this will give us absorption cost per unit. This will be fixed cost per unit. And our fixed cost per unit, we know that our fixed cost, it was given as 5 rand per machine hour. Don't forget, it was given as 5 rand per machine hour. They said that our rate is 5 rand per machine hour. So now we need to say 5 rand times by the number of hours it takes to manufacture 1 unit in terms of the machine. So now we know that it takes 1.5 to manufacture 1 unit per machine. So now they consume or spend 1.5 machine hours to manufacture only 1 unit. Therefore, now if the POR, which is the absorption rate, is 5 rand per machine hour, then it will be 5 rand times by 1.5, which is 1.5 hour to complete 1 unit of a product in a machine, times by 1.5 hours, because this is hours. Therefore, now we have to say 5 times by 1.5, and this will give us 7 rand 50 cents. Therefore, now 7 rand 50 will be the cost per unit. 7 rand 50 is per unit. And take note that the 5 rand was per hour. It was 5 rand per machine hour. But after we multiply that by the number of hours it takes to complete 1 unit per machine, then it will give us the fixed cost per unit, which is per product. Therefore, now that will give us an amount of 7 rand 50 cents. And after we draw a line there, then this will give us absorption income statement, or absorption cost per unit. This will be absorption cost per unit. That means now when we are using, or when we are calculating absorption income statement, we need to consider this amount, 750 plus 9 rand 20 cents. Then this will give us 16 rand 70 cents. So now this is the amount that will be used to calculate the cost of sales in the absorption income statement. In the calculation of the absorption income statement, this is the amount that will be used. So now the minute we have calculated the missing units, more especially the units sold, and we have calculated the cost per unit for the number of months, which in this case is only the month of October. Therefore now we can be able to do our October, then we can be able to October, we can be able now to calculate the both income statements that were required to do. And the first one that I will start with is the direct income statement. Direct income statement. Direct income statement. And under our direct income statement, we know that we start with the sales. Then after we less variable cost minus variable cost. And under our variable cost, we know that we have opening, we know that we have production, and we know that we have to minus the closing, minus closing. Then after that, we have to take into account all the variable cost. We have to take into account all the variable cost. And we did have variable manufacturing cost per unit. Therefore now we will have, variable marketing cost. Variable marketing cost. Then now we have to add our marketing cost. And remember, these are non-manufacturing costs. I just want to write them differently. Marketing cost was variable. Marketing cost, which was variable. Then we have to check for another cost that was variable. We had total variable administration cost. Therefore now there was administration cost that was also variable. Administration cost. Then we have to check if is there any other cost that was variable. No, there was no one. This has been captured. This has been captured. The reason why we don't take this variable manufacturing overhead cost per unit, the reason why we don't add this here at the bottom, it is because it was already taken into account when we calculated our cost per unit. It is already there. So now we don't have to double record our variable cost. In terms of variable manufacturing cost, it was already taken into account. This is variable manufacturing cost. So now when we calculate the income statement, we don't include, because it will be allocated when you calculate in the opening inventory, because that opening inventory will be based on the total variable cost, which is 9 rand 20 cents. And if you see here, this 9 rand 20 cents already include variable manufacturing overheads. So now there's no need, it must not be included in the calculation of the income statement as a separate cost. So now it will be 9 rand 20 cents. We times this by the opening inventory. And we know that opening inventory is 5,000 units. There was the opening inventory. We multiply the opening inventory by the direct cost per unit, which is only the variable cost, because the direct method only takes into account variable cost as the cost per unit. Then all other costs will be treated as period cost. All other costs will be treated as period cost. That means variable or direct income statement method treat fixed cost as period cost. That means cost that will be incurred only for a specific period of time. Then after, we will have our production, and our production will also be 9 rand 20 cents times by the units that were produced in the month of October. And only 17,000 units were manufactured. And in the case of closing, it will be 9 rand 20 times by the 6,000 units that were in the end of the period still left. With regard to the sales, don't forget, our sales will be 25 rand times that by the units that were sold during this period. And the units that were sold was calculated, and that amounted to 16,000 units. 16,000 units were sold. Therefore now we say multiply that by 16,000 units. And remember, the selling price was given to us as 25 rand, and there was no increase in any of the units, either selling price or the cost. that we have. So now everything is as it is given to us. So now we have allocated that. Then let us go to the marketing cost. Our marketing cost, it was given to us as variable marketing cost per unit. Remember, per unit, and that is R1.50 per unit. And as I said to you, that marketing costs are based on the number of units that were sold. Marketing costs are based on the number of units that were sold, because we are marketing a product with the intention to sell it. So now that is why this will be multiplied by the number of units that were sold. And the number of units that were sold was 16,000 units. It was 16,000 units that were sold. So now that is why we multiply by sales, because we are marketing in order to sell the product. So now R1.50 times by 16,000 units, it will give us the marketing cost in total for the month of October, or the marketing cost to sell the 16,000 units. Then after we have variable administration cost, and this is total. Take note, total. We don't have to multiply, so rate in total. Therefore now this was a total of 34,000 rands. Then we just record 34,000 rands as it is as a total amount, and this will be 34,000 rands. This will be 34,000 rands. So now we can then do all the calculations, and we know that after we said sales minus variable cost, this will give us marginal contribution. This will give us marginal contribution. This will give us marginal contribution, or contribution margin. It is in chapter 5 of your textbook, called contribution margin. So now the contribution margin will be the difference between sales minus variable cost. So now we start from the top, where we calculate our sales, and we say our sales are 25 rand times by 16,000 rands, and this will give us 400,000 rands. This will give us 400,000 rands. That will be the amount of sales. Then after, our opening inventory will be 9 rand 20 cents. 9 rand 20 cents. We multiply this by 5,000, which is opening inventory, and this will give us 46,000 rands. Then after, we say 9 rand 20 cents, we multiply this by the production of 17,000. Then if we do so, this will give us a total of 156,400 rands. This will be our production, and our closing inventory will be recorded here as negative, because we have to determine the total of the inventory that was the total of the inventory excluding closing inventory, because the closing was not sold. So now we say our 9 rand 20 cents, we times that by 6,000, and we remove the closing inventory because it was not sold. It is still there. 55,200 rands will be the amount of the closing inventory. And then after, we do the marketing cost, which is 16,000 units times by 1 rand 50 cents, and this will give us 24,000 rands. Therefore now this will be 24,000 rands, and the last one is the 34,000 rands that you can see already, which is administration cost of 34,000 rands. Then after, we calculate the total variable cost, and our total variable cost will be opening of 46,000 plus production of 156,400 minus 55,200 plus 24,000 rands plus 34,000 rands. So now this will give us 205,200 rands as the total variable cost. And if we less 400,000, this will give us a contribution margin of 194,800 rands. Contribution margin of 194,800 rands. Then after, we less our fixed cost. Then we know that our fixed cost will be made of the manufacturing fixed cost, manufacturing cost. It will be made of all other fixed costs that we have. It will be made of all other fixed costs that we have. And we had total fixed manufacturing overheads, which is 128,000. Total fixed marketing cost, which is 40,000. We also had total fixed administration cost of 25,000 rands. Total, and they are already in total. We don't have to multiply anything. 25,000 rands. Total fixed marketing cost 40,000 rands, and total fixed at manufacturing overhead cost 128,000 rands. So now the last one that we need to record, it is the administration cost, marketing and administration. So now we have marketing, cost. We also have administration cost, which is fixed. And our manufacturing overhead cost fixed is 128,000. And our cost, which is also fixed, it is the marketing cost of 40,000. Then we write our marketing cost of 40,000. Then after we have the last one, which is 25,000 fixed administration, there is 25,000 rands. Then we record that as 25,000 rands. And we add all the fixed costs, then we subtract that from the contribution margin, and it will give us the gross profit. Then from here we can just add all of them, and you say 128,000 rands plus 40,000 rands plus 25,000 rands, and this will give us 193,000 rands minus 194,800, and this gives us an amount of 1,800 rands. 1,800 rands. So now 1.8 is the gross, or is the profit. Profit for the month. Now don't forget the rule. Don't forget the Cotton rule. The Cotton rule says that if the opening inventory is less than the closing inventory, therefore absorption profit will be higher than the marginal profit. And honestly, our opening inventory is less than the closing inventory. Therefore, now that means the absorption profit must be higher than the marginal profit. So now that means absorption profit must be higher than the direct profit of 1,800. So now let us check if will that prove correct when we test the Cotton rule. So now we are doing the income statement, and this income statement will be the second one, which is the absorption income statement. This will be absorption income statement. Absorption income statement. And in the absorption income statement, we still start with the sales. And sales, they don't change based on the method. The number of units that were sold, they were sold in all methods. Nothing changes. The major difference will be the cost of sales. Because cost of sales in the absorption method, they are based on the full cost. Opening inventory, they are based on the full cost. Then we have our production, and production is based on the full cost, and closing is also based on the full cost. That means the unit cost including the fixed cost. Then after we have to say plus or minus over or under, over slash under. which is under applied. So now that means in this case we first have to determine the actual fixed manufacturing overheads in comparison with the applied. So now we have to say actual fixed manufacturing overheads minus applied overheads. Applied fixed manufacturing overheads. And we know that our actual fixed manufacturing overheads is 128,000 rands minus applied. When it comes to applied, we know that applied is equal to POR. Applied is equal to POR times by actual base. Times by actual base. And our POR, we know that it is 5 rand per machine hour. Our predetermined overhead rate, it is 5 rand per machine hour. Then we have to multiply by the actual machine hours. We have to multiply by the actual machine hours. And here was the POR of 5 rand per machine hour. Therefore, now we have to multiply by the actual total machine hours. Don't forget. So now our total machine hours will be the total machine hours to manufacture 17,000 units. How many hours does it take to manufacture 17,000 units? If it takes 1.5 machine hours to complete 1 unit, that is the question. How many units, how many hours or how many machine hours will it take to manufacture 17,000 units if it takes 1.5 machine hour to complete 1 unit? Therefore, now we have to say 17,000 units that were produced times that by machine hours 1.5. Therefore, now it will be 17,000 units. We multiply this by 1.5 machine hours, and this will give us 25,500 hours. That means it takes 25,500 machine hours to manufacture 17,000 units. Therefore, now we do have total actual machine hours, which is 25,500 machine hours. Then we can take the machine hours, we multiply that by the 5 rand per machine hour. Therefore, now that will mean it will be 25,500 times by 5 rand, and this will give us the applied fixed manufacturing overheads. This will be 25,500 times by 5, and this will give us 127,500. This will be the applied fixed manufacturing overheads, which will be recorded here as 127,000, as 127,500. That will be 127,500. Therefore, now the difference between the two will be minus 128,000. Therefore, now this will give us an amount of 500. Remember, this is the actual. This is the estimated. This is the estimate. So now we have underestimated because we only estimated 127,500. But we actually incurred 500. Well, we actually incurred 28,000. So now that means we have underestimated our cost of sales. Therefore, now this will be plus cost of sales. That means cost of sales will have to be debited by an amount of 500 to increase the cost of sales to become the actual amount that was incurred. And secondly, we had already calculated the fixed cost per unit. When we calculated our fixed cost per unit, and it finally amounted to an amount of 7 rand 50 cents. And remember, this was per unit. Don't forget that. So now in this case, if we wanted, we could have taken the 7 rand 50 and we multiplied by the number of units as opposed to the number of hours of machine. So now if that was the case, that will mean we'll have to say 7 rand 50 per unit, and we multiply this by 17,000 units that were manufactured. Remember, there were 17,000 units that were manufactured or that were produced. So now we can say 17,000 units that were manufactured. We times this by 750, which is 750 per unit. So now, which is per unit? That is per unit. So if you use per unit, you multiply by the number of units. But if you use per hour, you multiply by the machine hours. Take note of that. If we use per unit, multiply by the number of units. But if we use per hour, multiply by the machine hours. So that is why I took the 5 rand per machine hour and I multiplied that by the total machine hours. 5 rand times by the machine hours to manufacture 17,000 units. So now please be mindful of that. It is very crucial for you to understand how to calculate this in both using all the types of units. So now we have calculated and found out that we have underestimated our cost of sales. Therefore now this will be a plus in our cost of sales. So now we can immediately say under applied and say plus 500 because we've already done that. It is a very important calculation for one to understand. Then now we go to our opening inventory and to say opening will be based on the total cost, which is the full cost. Total cost, don't forget. In the absorption, we take the total cost, the one that includes the fixed cost of 7 rand 50 cents. But in the direct method, we only take the 9 rand 20, which is based on the direct cost per unit, or which is based on the variable cost per unit. But in the absorption, there is the absorption cost per unit. We take the total of 16 rand 70 cents. So now that is why we multiply that by 16 rand 70 cents. Then we say 16 rand 70 cents. We times this by 5,000 units that were in the opening. Then production, we say 16 rand 70 cents. We multiply this by production of 17,000. Then closing, we say 16 rand 70 cents. And we also multiply this by the closing of 6,000. Then after we check how much will be that opening. 16 rand 70 cents times this by 5,000. And it will be 83,500. It will be 83,500. It will be 83,500 rands. Then now it will be 83,500. Then after we say 16,500, 16.70 we multiply that by 17,000, which is 283,900. Then after we say 16.70, we times this by 6,000, and this will give us 100,200. And remember, closing must be negative. Closing must be negative. Then from here we can draw the line. This will give us the cost of sales. This is what our cost of sales are made of when it comes to the absorption method. Then now we have to calculate the cost of sales, and the cost of sales will be 83,500 plus 283,900 plus 500 minus 100,200, and this will give us 267,700. And we have to subtract the 400,000, and after subtracting the 400,000, this will give us 132,300. 132,300, and this will be gross profit. And please be mindful of the fact that in the case of the absorption method, sales minus variable cost. Sales minus variable cost. It gives us marginal contribution or contribution margin. It does not give us gross profit, please. Take note of that. It gives us marginal contribution. It does not give us gross profit. But sales minus cost of sales is equal to gross profit. Then after we less all the fixed cost, then after we say less fixed cost, then we less all the fixed cost, we have manufacturing cost. Manufacturing cost or manufacturing fixed cost. We also had marketing fixed cost. We also had administration fixed cost. Administration fixed cost. And our manufacturing overhead fixed cost amounted to 128,000. And our marketing, I think it was 40,000. Our administration, it was 25,000. Let me confirm that. Manufacturing, it was 128,000. Then we don't consider the manufacturing overheads. That 128 is already taken into account above. Remember, we had the over and the under of 500 rands. So now we only take into account the non-manufacturing cost. We only less into account the non-manufacturing cost. Less non-manufacturing cost. Let me note that. Less non-manufacturing cost. And under our non-manufacturing cost, we have the fixed costs that were taken into account. Fixed marketing cost, which is the fixed one. Administration cost, which is the fixed one. Then we also look for all other non-manufacturing cost, and we did have other non-manufacturing cost. In addition to such, there was another non-manufacturing cost, which was variable marketing cost. This is variable. Remember, this has nothing to do with the manufacturing. So now this 150, which was already calculated as variable in the variable income statement, there it was marketing, that was variable. It amounted to 24,000 rands. That is the one that we take into account. Therefore now this will be 24,000 rands variable marketing cost. And our variable marketing cost, let me confirm, yes, variable marketing cost, as I said, that it is a total of 24,000 rands. That 24,000 rands, remember, is non-manufacturing. Therefore now that will be 24,000 rands. Remember, we say less non-manufacturing cost, less non-manufacturing cost. All the costs that are not related to manufacturing, they are recorded below the gross profit in the absorption income statement. They are recorded in the or below the gross profit in the absorption income statement. Sorry for that error, just being tired of explaining for a long time. Then now we check for another non-manufacturing cost. Another non-manufacturing cost will be the variable administration cost, which is 34,000 rands. Therefore now we have to record the variable administration cost, variable admin cost, and our variable admin cost is 34,000 rands. Variable administration cost is 34,000 rands. Therefore now after we have recorded that, this will give us the total of the non-manufacturing cost. And please be mindful of the structure of these two statements. Another one record all the non-manufacturing costs separately, another one records the variable combined. So now let us calculate the total of all the non-manufacturing costs, which is 24,000 rands plus 40,000 rands plus 25,000 rands plus 34,000 rands, and this will give us 87,000 rands. And if you say 87,000 rands minus 132,300, this will give us a total of 45,300 rands. This will be a total of 45,300 rands. So now let me just recalculate that. We have 40,000 rands plus 25,000 rands plus 34,000 rands plus 24,000 rands. Yes, the amount is 123,000 rands. Not 87, 123,000 rands. 123,000 rands. Then that changes our profit at the end. Then that will be minus 132,300, and this will be a total of 9,300. Then that looks better, correct. 9,300 rands. 9,300 rands. Then 9.3 is the profit for the absorption income statement. This is the profit for absorption income statement, profit for the month. And this profit is surely higher than that of the direct method. Profit of 9.3 is surely higher than the direct method of 1.8. And why that is the case? It is because of that golden rule. The golden rule said that if the opening inventory is lower than the closing inventory, therefore absorption income statement will be higher than the direct income statement. So now that is surely correct, because 1.8 is less than 9,300 of the profit of the absorption income statement. Just to add the part of the question that was not required, reconciliation is something that is very important in this topic. A reconciliation of the two profits. We'll normally have the direct profit, and our direct profit will be 1,800. Then after we'll have increase, because our inventory has increased by the difference. Our inventory opening was 5,000. Our closing was 6,000. Then inventory went up by 1,000 rands. So now that means it will be our fixed cost per unit of 750 times by 1,000 rand. Therefore now this will be 750 times by 1,000. And this will give us 7,500. Remember, the 750, it is the fixed cost. We have calculated our fixed cost per unit as 750 cents. And if that is the case, then now we can use that and we multiply with it. Then we can add the two, and in adding the two, this should give us the profit of the absorption. 7.5 plus 1,800 will give us a total of 9,300. And 9.3 is exactly the profit of the absorption income statement. So now this will be absorption profit, absorption profit, absorption profit, and our reconciliation is correct. Now with that being said, guys, I will say thank you. I hope you will have learned something out of this activity.